Is there anything about the recent developments with the coronavirus that makes you rethink any of your investment theses over the next 5 to 10 years, let alone 1 to 2?
Yes. Thank you, Lisa. Great to be on the show again. So, of course, we have to think about something like this. I think in private equity, though, even though this is a human tragedy and it's causing a lot of problems in the short term, my guess is over a 5 or 10 year period, it's not going to influence results that much. But all that said, we have to be very careful about the companies we're looking at right now and making sure that their supply chains are diversified and that they're prepared for these type of events, because these type of events, maybe not this particular one, will probably continue to occur in the future.
On the flip side, do you see opportunities opening up with companies getting much cheaper to potentially swoop in and buy?
I wish. I have not seen companies getting cheaper.
Okay.
Maybe that will happen in the future. I know there's a lot of volatility in the markets right now, but we have not seen that reflected in pricing to date.
All right. Meanwhile, another consequence of this has been that interest rates, benchmark yields, have been heading to all-time record lows. And I'm wondering how that affects private equity returns going forward, just given the fact that all valuations are going up, expected returns going down.
Yeah, I think the valuations are very much connected to where the risk-free rate is, the 10-year rate. So if you have a risk-free rate at 1.3%, then the multiples that are being paid for businesses right now seem more reasonable. But if those rates come up, then that may not be the case. So I really think, one of the keys for private equity going forward is making sure that you're hedged against interest rates moving.
How do you do that?
Well, the way we do it is by making sure that the capital structures that you're putting in place are sound and they can withstand an increase in rates. But you can also use the capital markets, right?
Meanwhile, there was an article in the Financial Times this week taking a look at returns in private equity over the past decade. A Harvard professor talking about how they've actually been below on an annualized level. The S&P 500, Professor Lerner of Harvard, saying that there's been a huge influx of money into private equity, but when you look at the returns numbers from the last decade, it's hard to feel that there's really been much alpha at all. What's your response?
So my response is, the good news is that investors in public markets and in private markets have done exceptionally well over the last 10 years. So that study, which goes from June of 2009 to June of 2019, said that the public markets, the S&P 500, returned 15.5%, and the private markets 15.3%. Both great numbers. The key is nothing has changed in private equity. Those are good numbers. What happened is we've had a tremendous bull run in the S&P 500. And in those bull runs, it makes it very difficult for private equity to maintain its spread on returns.
What do you say to people who say that private equity has also had an equally good run during this bull market, given the influx of capital into that sector, and that those returns will also be somewhat lower in the years ahead?
Look, it's a very good point. And, but private equity, the spread between private equity and public markets tend to converge in times of long bull markets. The last time that happened was in 1999, after a decade-long run in the markets. But when markets are choppier, more volatile, or going down, that's when the outperformance tends to grow. So we can see just in the last few days that volatility does occur in the public markets.
So when you talk about that during choppy periods, since we seem to be in one at this very second, perhaps not in 1 hour, do you think that there are opportunities there to actually buy, or is it just that you're not exposed to the same volatility in pricing because it doesn't price in real time?
Yeah, what I'm really saying is in prolonged periods of volatility, downturns, choppier markets, private equity firms have some advantages, right? Because they control the companies, and their companies tend to make changes to deal with the environment more quickly. They cut costs, they conserve cash. And what's lost on a lot of people is that private equity has a pool of capital that is always available to these companies. Public companies, family-owned businesses don't always have pools of capital that are available to them to play offense during times of stress. And the only other thing I wanted to point out on these returns, that's just for the U.S. Because the spread of privates over publics in Europe and Asia has been maintained even in that study.